This is actually a question that we've gotten in meetings before from institutional subscribers. I mean, it centers on this demographics debate, specifically in the U.S. With close to $3 trillion in student debt in auto loans, how is it possible millennials can consume much more from here without going through a deleveraging phase first?
Yeah, no, that's definitely a key risk. I mean, it's millennials are actually less indebted than their baby boomer counterparts at this point in their life cycle. So that's something to keep in mind. I mean, obviously the baby boomers are the largest consumption cohort in the history of the world in terms of what they spent and what they made. So that's something to keep in mind. I mean, there's, the one thing you got to think about in terms of debt is that the economy is always growing on a nominal basis. So like the nominal level of debt doesn't matter.
Right.
I mean, I know 3 trillion sounds cool to say out loud and it's really scary and ominous, but it actually doesn't matter.
Yeah.
What really matters is the rate that debt growth, the rate of debt growth relative to debt service, and actually the change in debt service ratios. And what you see for the U.S. consumer, and particularly the broader U.S. consumer, is that the change in debt actually has been really low, really negative all throughout this cycle, and the change in debt service ratios debt service ratios are still on their lows, relative to this previous cycle. Now, we'll start to see the impact of the cumulative 100 basis points of Fed tightening we've seen over the last 18 months really start to seep into debt service ratios in terms of perpetuating those higher and actually having adverse consequences to consumer spending. But it's certainly not like we're going back to 2007 levels of debt service ratios or changes in those ratios, because that's what really matters, if you think about that perspective. And I think, do I have that in this guy? Yeah, actually I have this. So on slide 64, what we show, I charted this for the preponderance of developed market economies on slide 64. So on the x-axis, we have the change in the non-financial private sector credit to GDP ratio, and this is the total non-financial private sector, so obviously including corporates, but it's even more pristine for the U.S. for just households, because obviously corporates have levered up in this cycle. So on the y-axis, we have the change in the credit to GDP ratio, so basically just showing on a z-score basis relative to the trailing 10-year time frame. And then on the y-axis, we're showing that same z-score, trailing 10-year z-score, just for debt service ratio. And what you see here is that the United States, just from that perspective, is fairly pristine. You want to be in the bottom left box in terms of it indicates that you have room and capacity to lever up and capacity to take on incremental debt. So that's a good thing. Certainly for the U.S. consumer, it's actually even more pristine. You're probably even further down to the left on this chart.
No, that's good. I think the point you made is a good one. It's not talked about enough that if output growth is growing faster than debt growth, then I mean you can service that debt. The classic example is like a commodity company that takes out a lot of debt, and as long as their revenues are going up because commodity prices are going up, it's fine.
Yeah, exactly.
The upside down of that is what we've seen in that space the last 5 years.
Yeah, and I think just to wrap it up, a good coaching point or a teaching point to make on that question is just don't think about things in absolute terms.
Yeah.
Think about things in ratios and think about things in changes in those ratios and changes in those growth rates, because that's what really matters to markets. That's what really matters to the economy. The absolute level of anything is almost useless.
Yeah.